Hey, Happy New Year, everybody. So, this is like my third take for this. So, the first two, I notice I move a lot. So, I'm going to try and be a little more still in this video because it was driving me nuts, me moving around so much. So, anyway, Happy New Year. Sorry, I haven't really, I started the YouTube channel and didn't really do a whole lot with it. So, I won't say it's a Year's resolution, but I am going to try and post here once a week. Haven't figured out exactly the day. I just wanted to start off fresh today because it's the really first work day of the year, and I wanted to get out here. So what I'm going to do is start this kind of from the beginning. What I would like to do is once a week, we're going to dive into a mortgage product, kind of explain it, or if there's something that hits in the market, we'll talk on that. Something that is important, we'll get into that. But I'm going to start with the basics, right? So there's two different types of mortgages: qualified mortgage, called QM; non-qualified mortgage, non-QM. You're going to hear the words QM a lot, and just remember, there's mortgage lingo, right? Just like every profession, I'm sure whatever profession you're in, you have your own terminology. Doctors, accountants, lawyers, mortgage people, bankers, construction workers, a lot of different acronyms, abbreviations, words we use for things. So I have a tendency to go into that just because I've been doing this for 25 plus years. So it's hard to not have that, but I'm going to try real hard not to go into the kind of the mortgage jargon. But if I do, because I have to, I will try and clarify it. So let's go qualified mortgages first, right? So QM, that's basically what everybody knows. It's your Fannie, Freddie, 30-year, 15-year fixed, your standard mortgage. FHA and VA do get lumped into there sometimes, although technically they're not QM mortgages. But they get thrown into the same thing because it's kind of the normal, what everybody is used to for mortgages. So 30-year fixed, all of that. And the one thing, though, I do want to go into is, even with that, everybody thinks they know all about 30-year mortgages. You don't. And don't take that the wrong way, but there's a lot of caveats to it that I think people are mixed up on. One is, and I hear this all the time, and I'm still surprised, I need 20% down. You don't need 20% down. On Fannie Mae, Freddie Mac, there is a 1% down. Now, you have to qualify for that. So, and how do you qualify for that is through, it's your area, income, it's basically, it's your AIM is what it's called. It's the area, average income. What they figure that is, and then once you are a certain percentage of that, you could qualify for these mortgages. So if the, area income for whatever area you're in is $100,000. That's what the average person makes. If you make 120, you don't qualify. You're a little over. But if you make 80, because you're at 80% of that value, you could qualify for some of these programs. So that's where it gets into, and that's where it gets a little tricky, and people don't talk about it because a lot of loan officers don't even understand all of these things, and they don't even know how to find the AMI. But that's basically what it is. So you need to kind of know that. But just so you know, you could do a conforming 30-year fixed, 1% down, 3% down, and of course 5%, 10%, 15, 20, whatever, right? The other thing people don't understand is it's a 30-year fixed, but you don't have to do 30 years. Let's say you're doing a refinance, and you only have 26 years left on your mortgage. You don't want to go down to a 15-year because that payment may be a little bit much, but you don't want to go all the way back to 30 because it defeats the purpose. You've paid 4 years. Why pay 4 more years of interest? You can actually just do a 26-year mortgage. Now, a lot of people act like this is a new thing we've never had. We've had that forever. I've been doing that for 20 years for people. So you just need to know up front, and then when we get in, all we do is put in the number of how many months do you want the mortgage for. We say 26 years or 25 years. We say 25 years, 300 months, done, right? That's what your mortgage is now. So that's what your payment's calculated off of. So you can do that, okay? You can also do a 10-year, you can do a 20-year, you can do a 25, you can do anything. Anything over 10 years, you could pretty much do 11, 12, whatever, right? Now let's get into, so that's conventional. I mean, it's pretty normal. If you do less than 20% down, you have mortgage insurance. We figure that out. It's given to us, right? It's part of your payment. Escrows. Let's talk about escrows a little bit. So an escrow is basically your real estate taxes and your homeowner's insurance. Typically, if you put less than 20% down, you have to include that in your payment. So if your taxes are $3,600 a year, it's an extra $300 on your payment. If your homeowner's insurance is $1,200, that's an extra $300, right? Or $1,200, an extra $100. Sorry, extra $100 onto your payment. So if your payment is $1,200 or $1,500, on top of that, you're going to have $300 for your real estate taxes and $100 for your homeowner's insurance. So that's $1,900, and let's say $100 for mortgage insurance. So now your payment's $2,000, but $700 of that is going to other things. Those are your escrow items. Okay. So we'll put that in there. Not everybody has escrow, and the great thing is we have investors too that will actually waive escrows. They don't require you to include that in your payment, all the way up to 95%, as long as you have a good enough credit score. Sorry, a little water. So you can do that. We can waive escrows. The other thing I wanted to get into then is FHA. Okay, so FHA, 3.5% down. Now, interest rates are typically a lot lower for FHA, but FHA, the biggest misconception I see all the time on FHA is the actual misunderstanding of what FHA even stands for. It's Federal Housing Administration. It's not first-time home buyers. Okay, everybody thinks FH is first-time home buyer program. It's not. You could do it for your 10th house. It really doesn't matter. Now, you can't own 10 houses at the same time and have an FHA, but, well, I guess you can if it's your primary residence. But it's typically your primary residence, 3.5% down. The beauty of FHA is it allows you higher debt ratio, so you can qualify for a mortgage and have more debts out there. It also has a lower interest rate associated with it. Now, mortgage insurance is higher on FHA, so the interest rate being lower doesn't necessarily mean you're getting a great lower payment than on a conventional, and sometimes it comes out about the same, but it's easier to qualify for an FHA, so that's why you hear so much about FHA. VA, no money down, right? And if you're disabled and you're get to waive the funding fee, there's no funding fee whatsoever either. Escrows typically are in an FH or a VA, but if you put some money down, you don't have to. Those are great loans because, once again, no mortgage insurance, no money down, but it's for veterans, so you have to be a veteran and honorably discharged. And your DD 214, we need that, and then you'll also we could take care of getting the eligibility, but you can get that off of the VA website. Now, refinancing. Let's go into that a little bit. VA, easiest refinance in the world, called the VA IRRRL. It is the easiest thing to do in the world. Takes like 7 days to do. Typically, no appraisal, no income. Don't really need anything. FHA has streamlined refinance, so we could do that. Now, the one caveat with that, because we don't need an appraisal, don't need, usually income or any of that. But you have had to have the loan for a certain period of time. So for a Streamline, you have had to make 6 payments, had the loan 210 days. And you're not allowed to roll in much of your closing costs. So typically on a VA or a FHA Streamline, you're going to bring 1 or 2 months payments to closing, but you should actually not have a payment for 1 or 2 months. It correlates. That's how those work. Regular old conventional QM refinance, yeah, we can roll in closing costs. We could do all that. Cash out is considered a cash out refi, so that's different. Then you would need an appraisal and all that. If you're doing a rate and term refi, it depends. It'll tell us if it requires an appraisal, income docs, all that. We don't know. So that's QM. That's your basic stuff. Non-QM is the exciting world, right? It's the world where we can do a lot of different things. Bank statement loans, profit and loss, rental, just use the rental income to qualify. 1-year tax returns instead of 2 or 3. A lot of different things we could do there. There's actually even a program out there, if you have enough money down, we don't even need income. We don't have to verify that whatsoever. So there's a lot in there. We're going to go into that, but I don't want to dive too much into that today because it does get involved. But just understand that there is a world out there where you can get a mortgage and it is not, you don't have to be W-2, you don't have to be able to prove your income. Maybe you get paid cash. We can do loans for you, right? Or you just have your ITIN. You don't have a social. We can do a loan for you. There's a lot of things we can do, all right? And that's what I wanted to go through today, is basically just those types of things, and then we're going to dive into those as we go. Now, one thing I want to say, too, is I'm excited. There's actually been a few people that have subscribed to us, so that's exciting. If there's something you guys want to hear, let me know. All right? I want to be here and kind of get into what you guys want to hear about, too. Sorry about that. Not just, the topics I'm thinking of. Because, once again, being on this side of the desk is a lot different than being, on your side of the screen, right? I'm talking into the screen. When you guys are hearing it, you're going to have questions, and I want to hear about those questions, and we can dive into that, all right? So that's it for today. We'll dive into more of these as we go, but I hope this is going to be exciting. I look forward to doing this and talking to you guys every week. Bye.